Is tax alpha Wall Street's latest ploy? Welcome back to the latest installment of the Million Dollar Question. I'm Stephen Weitzel, managing partner, Reveille Wealth Management. Thank you for joining us. Let's jump in. So, we're seeing this tax alpha thing a lot. Clients ask about it. I had a wholesaler in the office yesterday telling us about it. And I have to be honest with you guys. I'm I'm more than a little skeptical. I feel like this is mostly just a marketing ploy from Wall Street, um, because they're trying to find ways to replace revenue that they've lost somewhere else. That's my perspective. But I want us to talk about how we have gotten to this point, because it's being positioned as a little bit of an innovation, and there have been innovations in the financial markets over time. So way back in the day, it was nothing but buying individual stocks and bonds, or maybe commodities futures or something like that. But we saw the rise of investment pools, which really became mutual funds, and that allowed the public, or people who didn't have the money to be able to buy all of these individual stocks or bonds or whatever it may be, the ability to be able to invest a smaller amount of money and diversify. And so that was, as we've learned from the Harry Markowitzes of the world, that's the only free lunch out there, is the ability to diversify. And so then Jack Bogle comes along. He innovates again with the index fund, and he says, well, really the active managers, they're not really outperforming over time, so we're going to create this index, or replicate this index. It's going to be about low cost and just tracking what the market is doing over time. Exchange traded funds, followed after that. And while initially ETFs were mostly about tracking indices, that's where there has been the most growth. I feel like over the last 5 to 10 years, that space has grown exponentially, because a lot more active managers are now using ETFs, because there are real tax efficiencies to using the ETF wrapper. That is probably one of the best things that has happened for investors in a long time, is that we're seeing the active management space gravitate towards the ETFs from the traditional open-ended mutual funds, where you're redeeming or purchasing directly with the mutual fund company. And the fact that a lot of these mutual funds now are converting to ETFs, and that the IRS is allowing these conversions to happen without any tax consequences, is a real benefit to investors. Now, let's go back to kind of the earlier days in my career. So this was pre-financial crisis, but late 90s, early 2000s, the separately managed accounts started to become a lot more vogue, and they were really a replacement for more affluent investors that were looking for more customized, tax efficient strategies, as opposed to just owning a mutual fund. And so that is why I find it kind of confusing that all of these direct indexing type strategies that are being promoted now, they're being paraded around as being new, but they're not. This isn't a new thing. These are nothing but separately managed accounts where you own individual securities, and the managers have the ability to go in and do some tax loss harvesting along the way. But they are marketing the hell out of this stuff right now as being some sort of groundbreaking tax alpha discovery. And at the end of the day, this is nothing more than marketing something in that's a slightly different animal of something that's been around for 30 years or more. And so back in the early days of my career with these separately managed accounts, nobody was doing any sort of index replication inside of that. Uh, there were active managers who were doing this. But I want to talk about this idea of the tax loss harvesting. So, tax loss harvesting has been around since, I mean, we finished reading Andrew Ross Sorkin's book, 1929. There were people who were selling positions and taking losses on things back then to offset gains that they had in their portfolio. This is not new. This is not a novel thing. My issue with a lot of the tax loss harvesting, the way that it's positioned to investors, is that that you're doing somebody a real favor with that. Well, understand that the nature of tax loss harvesting is, in the way that it happens most of the time, is you own positions in a brokerage account, a taxable brokerage account, of course, and you have losers in your portfolio. In through October, November of the year, you see something is down, maybe somewhat materially from where it was entered into the prior year. And so you decide, I'm going to sell it and I'm going to take that loss. And then I'm going to go and find another position that's appreciated and I'll sell that, and I'll neutralize the tax impact of that gain. Well, the only reason that can happen is because you've been accruing a loss somewhere else. I just think that it would be better to try to head that loss off at the pass instead of letting it continue to worsen over time and get to a point where you say, I've got some really large losses here and I'm going to go and sell some of my gains. The only reason that it's tax neutral is because you haven't made any money. This has lost, this has gained. Net, net, there's no change. And that is by and large, what is happening inside of some of these strategies, these direct indexing type strategies. Now, they are looking to take losses on positions over, a certain interval. Maybe they do it quarterly or semi-annually or whatever it is. And then they just accrue and they build up these losses in the portfolio over time. And so they espouse that the benefits of these strategies are that you're going to potentially boost your after-tax return versus funds or ETFs that could potentially pay out a capital gain distribution, and that you can benefit from the tax loss harvesting inside of the direct index themselves. And you cannot do that inside of the fund or the ETF. They are correct about that. They say this is going to help you potentially reduce your concentration risk. So what they mean by that is, let's just say I work for a Fortune 500 company and I have stock in that company. And, I've got $100,000 worth of, Apple, right? I work at Apple. And I've got that stock in my brokerage account. Well, I may not need to own a whole lot more Apple. And if I were to just buy the S&P 500 index, I'm going to get a pretty significant amount of exposure additionally to Apple. Well, inside of the direct indexing strategies, if I were to contribute the Apple to that strategy, I could say, well, we're not going to buy any more of it. And so they could, in effect, reduce your concentration risk marginally as a result of that. They tell you can gift your highly appreciated positions from that direct index. Well, I got news for you. You can gift highly appreciated ETFs or funds. So that's not really a novel thing that you get out of the direct indexing You have the ability to gift highly appreciated positions that you have elsewhere. And then they also tell you this could also better align with your values as an investor. Want, want. That's precious. Uh, I don't really subscribe to that sort of thing. Um, I want to talk about the cons. And this is where I think we need to be a little skeptical about this. Because for a lot of these direct indexing type products, again, this isn't anything new. It's done as a separately managed account, which is something that's been around for a long time. But they're looking to replicate an index like the S&P 500, as of, for instance, that's the one that is most often replicated in these types of strategies. And you could buy the S&P 500 index ETF for a couple basis points worth of internal expense. And so they're going to charge you many, many times more that in order to be inside of that direct indexing strategy. They're going to charge you many times more. And so they're part of the spin that they tell you why it would be better for you to pay substantially more for index replication. It's not because they're going to add any conventional alpha. No, it's the tax alpha. And ultimately, they believe, and they will try to demonstrate in a lot of these marketing illustrations, that the amount of tax benefit that you could potentially receive is going to outweigh the substantially higher fee that you would pay if you simply were to own the S&P 500 index on its own. So, I want you to be skeptical of the strategies that Wall Street brings to you. I do believe that financial advisors in this business, they are trying to help their clients by and large. But our industry is here not because it's a not-for-profit. It is a for-profit industry. And they're trying to make money. They're trying to find ways to make money in areas where, somebody has been in the S&P for many years and they're doing it almost for free. How could we convince them to pay 10, 15 times as much? And we've got to be able to provide them something that they couldn't do on their own. And that's this tax alpha idea. They're saying the investor can't do that on their own. They have to come to us to be able to do that. I've heard the same thing when I worked in some of these large firms in my career. As we've seen the Schwabs and Fidelities and Interactive Brokers of the world, the ability for the do-it-yourselfers to be able to manage their money, they have, by and large, access to the same types of solutions, investment products that most financial advisors do. And so the big firms have said, in order to justify their business model, we have to give them something they cannot do on their own. Most recently, that was these these alternative investments. You can't get into these alternative investments on your own. You've got to go through an intermediary. You've got to go through your advisor. And we talked about on the show last week, we talked about these private credit issues. Private credit was very vogue for a long time. And this is how it's going to help you as an investor. I don't think it's working out so well. Okay, that was the latest installment. Right before the financial crisis, it was, we've got these collateralized debt obligations, right? And the list goes on and on. You go back into the 80s, it was portfolio insurance. Yeah, you read about the crash of 87 and how well that portfolio insurance ended up working. So all I'm saying is be skeptical. I do not think that somebody doing a direct indexing strategy is going to get blindsided the same way that people are in private credit, the same way they did in the CDOs or with the portfolio insurance in the 80s. It's not that same type of a thing. But what I am saying is that the industry is trying to find a way to market that we're doing something novel. It's not novel, but it sounds good and it sounds fresh. And ultimately, they're trying to give people a reason to see value in paying up many, many times for something that they could get in a much more simplified, passive manner, almost for free. Here's the last thought that I'm going to leave you with. Ultimately, it's not our job as advisors to be able to give investors access to the market. They can get that on their own. It's our job, and this is ultimately where the value is. This is where the alpha is. It's not, can I get you exposure to the market? It's whether or not, it's having the wisdom to know whether or not you should. Is this environment conducive to investment? Yes or no? That's the real alpha. And that is what investors need to prioritize. This whole idea of tax alpha is predicated upon the fact that you're going to have this level of risk in your portfolio constantly. You're going to have exposure to large cap US stocks anyway. We think that we're going to be able to give you a better after tax rate of return. The presumption there is that you're going to be in regardless. Maybe you don't have to be. Maybe you shouldn't be all the time. So, food for thought. I just want you to be skeptical and ask questions whenever a financial advisor, a wholesaler tells you, hey, this is something that's new, that's out there. Are there people who are going to be able to benefit from direct indexing? Yes, there are. Is it the be all, end all type of silver bullet that I think it's being marketed as? No. All right, everybody. Thank you for tuning in for this latest installment of the $1 Million Question. As always, if you have questions for us, send us an email, info@reveillewealth.com. We love hearing from everybody. But thank you so much for spending your time with us this morning. I'm Stephen Weitzel. I'll see you next time. Take care.